S&P attempting to break out on Friday at the end of the month. We have a lot to go over, talking about the indexes, what GDP is doing. Was PCE important? What will the Fed do next week? What will Apple do next week? How sustainable is this rally? These are some questions we're going to go over today. We also have to look at the monthly charts and what's happening with the Nasdaq. What is happening with Microsoft? Why isn't Google participating? What is going on in financials? Is this really the end of what we were expecting to see with FRC? Is this going to be the end of the banking crisis? What are the best stocks to buy for the banking crisis and how to benefit from that? So we have a ton to go over, and we're going to just jump right into it. As always, subscribe to the channel, click all notifications. Please comment on the format of today's video. You'll notice over the past couple weeks, I've been trying different formats to see what you like more or what works better. I tried some memes and things like that, which were actually a lot of fun for me, but sometimes that takes away from me actually creating content, and it takes away from time. And this week's just way too important because of what happened and what could happen next week. So let's get into it. So we have the ES right here, and we all know this level, but let's just talk about this level for a second. You can see right here, this is September, and this is what we're marking off. Okay, so if we take a look at September, and we take a look at this particular bar right here, and we just look at the close, and that close is 41.91.50, and then we go to the next close, which is close to it. 41.93.75 is where we got to, but we closed at 41.88.50. We were not able to make a new close on Friday. I think that's significant. I think we have to pay attention to it. Now, that does not mean that you are not going to make a new close, but it does mean that we have to understand who's buying. And we're going to be going over smart money, dumb money, and we're going to be talking about the breadth of the market a lot today. So if we take a look at this and we just study this for a moment, well, we have some things that are very obvious, and it's really important we get why this happened again. And I've been hammering this point home that we have been in an economic-driven cycle. And the one thing I've been saying in these videos is less and less is important on the economic front. And I may have been premature, and I may have just thought in my head that everybody knew exactly what was going to happen. You can just see these higher lows happening. So it is possible that I discounted the significance of what's happening with GDP, and we're going to address that. And I think it's important to note, you always have to go back and just check your thesis, right? So we can see where these lows are, and we can see that if we were to create a stair, that you would just be stepping up on those lows all the time, and you're squeezing right against this. It's like the mother of all VCP patterns, right? So you look at this and you go, okay, well, this is what's happened. Why is it happening? Well, when we reversed right here, we reversed because GDP came out, and GDP was not good. Now I'm going to put in why this is important, okay? This is important because there's several components of GDP, and we're going to address them very quick. But these are just the headlines. Now, if we look at GDP and we see what's happening right here, we can see the US GDP grew at an annual rate 1.1. Well, we were looking for 2%, and that came in below the 2.6. So their estimates on what they're expecting were halved. Now, this is important. Now, there are four components here of what makes GDP, okay? Personal consumption, business investment, government spending, net exports of good and service. And we're going to talk about why this is important. So we have an estimate. We know what the four components are. And that estimate came in 50% less than expected. Now, who creates these estimates are all the bean counters, and they determine what's going on in the market. Now, next week, May 2nd, May 3rd, we have a Fed meeting, okay? Everybody is predicting that we're going to go and have 25 basis raise. That is what is the prediction. Now, whether that happens or not remains to be seen. I'm just going to touch base on PCE real quick, which is the number one thing that the Fed watches. And we know for a fact that they're putting themselves in a position where they're coming right in line. It is possible with the banking crisis that we have going on, which we're going to address and how to play it. That's the most important thing this weekend. I think if we look at the banking crisis and we look at what's going on here, and them saying that they may not have to hike as much due to the banking crisis and how that's going to tighten financial constraints, we could possibly break out here. Now, we're fortunate enough that it's the end of the month. I'm going to leave all my marks in from the daily, and we're just going to look at that on a monthly chart. If you were to look at that and it wasn't the S&P, what would you think? Let's remove everything and let's just draw the most basic line. We know this is the breakdown bar, right? We can see that this is a breakdown. You have the doji, you break the doji, you have a little bear flag right in here, right? We can see that. We can see this is the breakdown bar, and then the undercut and failure, right? Everything's going to zero, blah, blah, blah. So this is the bar that's important. And why is that bar important? Because that is the control bar, right? I always look for what is the area where we were being controlled. I think you'll find it very interesting that this is the same exact time when you really look at the bottom of this chart and where we stopped, that this falls just perfectly in line with that CPI report that came out on that date in October. Going back to the point that I'm making, that the economic data still might be more important than I have been giving it weighting for. Breaks out sideways, can't get over that number, cannot close over this high. Let's get the exact number of that high, 41.75. You have not had a monthly close over 41.75. Do you know how long it's been since you've had that close? You've not had a close above 41.75 on a monthly for 12 months. Think about that for a minute. You are at a 12-month close that you have not had, okay? A new high, 12 months on a monthly chart, right? Obviously, we are going to have closes that are higher over the past 12 months. But if you think about that for perspective, and you just put that into perspective, and I know I'm spending a lot of time on this, because you have to look at the macro picture, because it's all one big trade right now with nuance. Now understand, when we're looking at these charts, we're looking at long-term perspective. We're not looking at short-term perspective, but let's just take a look at a couple things. Meaning we're looking out months when you're looking at these charts. We're not looking out Tuesday or what's going to happen with Apple. But this is a really important distinction. If you look at the histogram, and when the histogram flipped, and when the MACD started getting closer and closer to one another, this happened in September, October. Same day as what? That CPI release. So if you look at this, we are creeping up and getting ready for these two to cross, okay? Now, that is a monthly long-term signal for those that use MACD. At the same time, here was your sell signal. And if you just start looking at these dates that I'm just marking here, I guess we could use this was your last buy signal. How'd that go? Well, that went pretty well. The market will move, and then they'll explain to us why it did what it did. So we see these turns. We see right here, and I think it'd probably be better if I get rid of this, and then what we'll use the arrows. I think we'll put the arrow right there. Now, if I'm just looking at that as a long-term signal, okay, and I'm looking at this color coding change, which I do look at the histogram, and I do look at this color coding change, right? Dark green to light green, dark red to light red, and I'm looking out long term. I don't know how you're looking at this and saying we're going to take out the lows because of what? What is going to get us to take out the lows? I am very concerned about the breadth of the market, and we're going to walk through this line by line. So this is the SPY breadth of percentage of stocks above their 10-day moving average. And what they're doing to determine SPY breadth is how many stocks on a percentage basis are above their 10-day. And there are demarcation lines based upon short-term and long-term. And we're going to start with this. So if we just kind of look here, it's not realistic to have every stock above the level, right? Not every stock, not 100% of stocks can be above there. That's probably a peak, and then you can see how it starts to work off. And that's exactly what happened here. They worked off. And then what happened? Well, we got to a point where it's just not feasible for that to stay there, right? The easiest way to look at it is below this line, that is really very pessimistic. And if you're above this line, it's very aggressive. You'll probably see a lot of the peaks marked on this 10-day right here. And you can see that, right? And this is a really good short-term indicator on what's going on. And just, you can pick any peak and you'll see it. It's not rocket science. I mean, if you think about it, it just means that everything's gone up so far, so fast that it's just not sustainable to have that same. I mean, that makes sense, right? If we look at this and we look at where we were and we look at where we've came from, we look at the bounce and we realize that we're nowhere near up here, are we? We're nowhere near this demarcation line on where these tops are. Well, that's interesting, but that doesn't answer the breadth question. But it does say to us that there's more room. There's more room before you have an indicator here that determines from breadth that we are overbought or oversold, right? So we can all see that. Now, if we take a look at the SPY breadth over 50-day, right? And we take a look at this. What is this telling us? Here's a peak. Here's a peak. We can see these peaks. And it does seem realistic, once again, that getting to above an 80 or a 90 level, which is right around here, right around where you are, if I draw my demarcation line, that's probably not realistic and it's probably not sustainable for that to continue, right? At some point, just as these trough valuations are not sustainable, not every stock is going to be below the 50-day, right? And so when we see that, we kind of know like, okay, that's a little goofy, and maybe we're due for some kind of relief rally. Doesn't mean it bottoms in, but that's a pretty good indication. Well, another line right here, like, is it realistic that only 20% of all the names are above their 50-day moving average? That's probably not realistic, right? You would think that, just say, is a median line. So once again, if we look at this, we're going to see a couple things. The very first thing we're going to see is that we have plenty of room before this indicator on the breadth or percentage basis, and how I utilize it, is giving us a sell sign. We're very far off of that sell sign. Now let's look at what else this is. Well, this is telling us that we have a little bit of a negative divergence, right? And we should probably talk about this. So there's that divergence right there, and you can see how this is going higher right here, okay? That's a divergence. That means the market's going higher with fewer stocks. That is not what you want to see. And if we say that the 10-day is a short-term indicator, we would say that the 50-day is a medium-term indicator. What if we use a long-term indicator? What if we go out 10 years? And let's just go out only 10 for a moment. We can see every single time that we are below these trough levels, as we were before, they're marking bottoms. And we're right around that area. And if we look at exactly when this happened, and we'll drill into that in a moment, you're going to notice something, okay? That's going to have happened when? Right around October. Here we are again, talking about, yes, the market bottomed. I've been saying it for some time. The market bottomed. I mean, I don't know what people are actually waiting for to say that. It doesn't mean it's going to go up, but it's pretty clear that the market bottomed. Now, we have that line. We see that demarcation line. Well, let's go back a little further now, and we'll clean these off. They're not going to match. And go back and take a look at history and say, how many times were we really this low? How far back we can go? Well, we can go pretty far back, can't we? So let's take a look at the time that we were here and that we undercut that line. And I'm using that demarcation line from 1998 right here, which was the Russian debt crisis. Every single time that we've gotten below this, we've had some kind of bottom or bounce. Every single time. It's not once. It's every single time, okay? So if we're looking at this data and we're looking at it over a long period of time, and we're looking for something historical to tell us where we're going to be in, let's say, a year, right? Let's not talk about where we're going to be Tuesday for Apple, and we're going to get into that. But this is really important for people to get this, because sometimes people can't see the forest through the trees. They just can't. You're not up here. You're in the middle. If we zoom in now on this long-term indicator, well, this gets even clearer, doesn't it? This gets glaring that this is most likely a bottom, right? So let's define this so you can understand where my head is. We've bottomed. It doesn't mean that you don't drop 10, 15% from here, but the bottom's in. And if you missed it, you missed it. And you can wait for the next great correction. I'm saying this for a reason. The majority of people that become perma-bears, and you look at people on FinTwit and go, how the heck is this person still bearish? Okay, they never develop the kind of mindset. And I'm not going to get all earthy, but it's a growth mindset. You get fixed. You have to be right because you did not buy the bottom. It doesn't work that way. Nobody buys the bottom. No one knew this day that that was the bottom. It was perfect if you were doing it from an economic data standpoint, and that was your bottom. Now you can see when you get above here, that does mark a high. You're far off that line, but there is something troubling here, and that's what I want to address now on the shorter term. This looks like it's still going up, right? And we've already identified that by looking at the monthly chart. But we're going down. So I still have negative breadth. Now, negative breadth can reverse itself, and you can get the breadth to get better. That's what you need to do. So I'm going to walk everybody through this. Now, whether or not you use TradingView, you can also do this if you have some of the other charting software, but I just want to make everybody aware of this so that you can monitor what I just showed you yourself. Okay, here it is in a 20-day on a monthly basis. Let's just go out and do a daily basis so that we can see this. Okay, and this is percentage of stocks above the 20-day. And you can see very clearly the symbols are right here. So all you have to do is type this symbol into TradingView. It's free, and you can take a look at this data for free. Okay, I'm always trying to find free services for people because I know that this can become costly, especially when you're starting out. And you can see my demarcation lines here on where I make my decisions, very similar to what I just showed you through Sediment Trader. We know we have weak breadth, but the market's going higher. Now, I'm going to recommend something here that I usually don't. I'm going to recommend that you replay some of these parts a couple times, especially with what I just walked you through with breadth. There are certain things here that you really need to just get an understanding of what's going on. So if this was a stock, and this is the Nasdaq futures, and let's just say that this is a stock. They make widgets. Would you be interested in that? Well, I've got a 200-day moving average that's pointing up, so that would be positive, right? I have a cross right here. So I've got a golden cross on the Nasdaq. So that's pointing up, right? And that's always a positive sign. And we haven't really had one of those since when? Well, since the death cross. Well, where was the death? I'm glad you asked. It's right here, okay? And you can see that was a year ago. Well, what does that fit into? Well, that fits perfectly with what we just talked about with the ES and the fact that we're now hitting about a 13-month monthly high close. Now, you're sitting in here, and if you were to look at this as a stock, would this be something that you would be interested in? The answer is yes. And essentially what really happened to us was we had that one shakeout ahead of Microsoft, and it looked to me like we were going to break. That's a break with no follow, but that's a break nonetheless. So it looked to me like we were going to break. That's not what happened. The exact opposite happened. GDP carried more weight than I thought was anticipated. I was under the impression that everybody knew that we're on the last tail end of the rate hikes, and apparently they're not getting it. Now, you already have home builders coming out like Federated Homes and saying they expect negative GDP growth third quarter, fourth quarter, which could mean earnings revisions. But according to Goldman Sachs, 81% of stocks that have already reported have met or beat expectations. We have a 6% increase year over year. We were expecting a 7% decrease. Okay? This is staggering. Now, we all have seen the blow-ups that are out there. This looks very different to me than the ES. And there's a couple things that are going on, and we should talk about it. Now, first and foremost, I have no breath in the market. And there has never been a time in history where the Nasdaq has gone up consistently without semiconductors. I'm going to say that again. There's no time in history, okay, in at least the past 2 decades since I've been trading, that there is a sustainable rally in the Nasdaq without the semiconductor index leading the way. Same with the S&P and financials, and we're going to get into this now. Here's the doji. What's in charge? The doji's in charge. Okay, you break the doji. Do you have follow through when you broke the doji? You've never had follow through from the day you broke the doji. Break it here, you get the reversal bar. Breaks it here, you get the reversal bar. Okay, this doesn't get any clearer that this is the bottom. Okay, what's that correlate to? I'm going to leave those in there, so we're going to get to those in a minute. Let's use the blue line. Okay, what's that correlate to? CPI. Economic data is driving it, period. It's very, very clear what the driver is. Now, I'll leave that there for a second. You have a base that's been building here for a year. No matter how you want to look at it, we can put any moving averages you want in, and you can see your breakdown bar right here pretty clear, right? This is your breakdown bar. This is your bear flag right in here, and you can see it. Doji can't break, breaks it, follow through. So you can see the break of the bear flag there, okay? So the bottom of this bar has significance. The bottom of this bar has significance. Let's take a look at that. Look what happens when you put that there, and you put it right on that bottom, okay? Well, the past 2 months, when we tested, failed, tested, failed, 1, 2, 3, 4 months tested and failed, 5th month tested, failed, what just happened? Closed above it. Now, the close on March was 13,301.75. Our close now is 13,302.25. Okay, so we do not, you see where I'm going with this? Look, 13,301, 13,320. Guess what we have? We have a higher high. We did not have the higher high on the ES, even though we're not over that level. To me, this is somewhat of a dragonfly kind of pattern where we have the low, wicks a price rejection, and you can see how this is going to play out, right? You can see that this doji, call it a dragonfly, is in charge. Let's get rid of this arrow, and let's just talk about this. This is the death cross that happened on the Nasdaq. This is the golden cross that happened on the Nasdaq futures market. So if you look at this, to me, I don't know how we can stay negative if we're going to start taking out these higher highs. If we were going to go down and we were going to break, let's go into this in a weekly and just drill into it for a moment so you can see where I'm going. If you look at these levels on a weekly basis, okay, and you just look at what's happening, well, it's pretty clear, right? You're coming across, you tested a year ago, or August, you tested right here. You should be able to see that. And it looks to me like you're setting up to test again, doesn't it? Now, on a weekly basis, you don't have the higher close, but we're looking at the monthly charts because we're fortunate enough to have the monthly charts right now. Now, let's just talk about what's going on here, and I'm going to be Captain Obvious for a second. On your MACD, you can see your sell signal there, and you can see how that correlates perfectly with that bar, right? I mean, it's glaring, right? We can all see that. We can all see how the histogram is getting closer and closer. If you don't like MACD, that's okay. I do. And I like using it from this to get a sense of what's going on. So now I have MACD pointing up on a monthly chart and I have the signal on getting ready, and if this crosses here, then you're going to get a buy signal. Now, maybe you don't get it this month. Maybe you get it a month later. If you're looking long term at this market, you need to pay attention to what happened, because what happened last week really defined the month, and that was based upon the economic data. And that's the point that I'm getting at, that we're still waiting on this economic data. So if we're still waiting on the economic data, and we know the Fed's going to meet this week, let's play devil's advocate. Let's say the Fed comes out and raises 25 basis, right? Let's just say that they raise 25 basis, okay? What's the market going to do? Well, it's already factoring it in 25 basis. We know they're not doing 50 basis, right? There's no way in the world with those numbers that just came out on GDP, they're doing that, right? So we look at the 10-year. We realize that we can't even hold the 200-day moving average anymore, okay? We know we can't even hold that 350 anymore, okay? So we look at the 10-year, and the 10-year's being bought ahead of this. All right, so we're either going to do 25 basis points and we're going to shrug it off, or they may halt. Okay? So to me, the pressure right now after GDP on the way the indexes are acting are telling me that people think that they're out of position. Because it's either going to be relief that the 25 is over, or they're going to pause and the market's going to rally. Now I'm going to give you a couple other reasons why I think that this could happen. But let's just take a look at the dollar really quickly here, because it's the end of the month. The dollar, talked about these death crosses before, and I just want to walk through them again. I'm going to just show everybody I use a 55 versus a 50. I really don't care what you use. You can use a 55, you can use a 50. It's your chart. You can do whatever you want. So, see that level? Once you have a death cross, your resistance becomes the 200-day moving average. Once you have a death cross, your resistance becomes the 200-day moving average. I'm saying it twice on purpose. I don't care if you believe it or not. Go look at anything and you'll say it, right? Facts don't care whether or not you believe in them, right? It doesn't work that way, okay? Here's your golden cross. Look where you held, the 200. I'm shocked. Okay, you come back and you take a look at the S&P. You look at the death cross, 200, 200, 200, right? Over and over again. When did it finally hold? When you got a golden cross. I'm more than happy to comment on that, and we can debate it in the comments. If that dollar's weak, well, what does that mean? Well, that means goods and services that we in this country sell overseas, like Microsoft Software, Caterpillar Tractor, they're cheaper. They're cheaper to people than they were. They're going to buy our goods and services. Now, when we travel overseas, we don't get the same exchange rate because we don't have the strong dollar that we had up here. Right? When the dollar drops, okay? When the dollar drops, okay, we lose purchasing power. But the rest of the world gains purchasing power on us. Okay? So we lost 11% of purchasing power during this period in time. You'll note that this DXY high is right around the same time as the S&P low. Now, we know we have a weak dollar, which benefits equities. We know that they're buying treasuries ahead of the market, okay? Now, what else do we know that has been really a weight on the market? Well, the number one weight on the market is the Fed, in their infinite wisdom, decided to figure out what they could break, because that's what they're best at. They raise rates until they break. Go look through history. That's exactly what they do. No reason to even have the moving averages in. We can all see how ugly this is. We can all see this line, and this is obviously the regional bank index. We're going to talk about this because this could be the driver. If this gets behind us, this could be the driver. Now, I'm not suggesting that they are not going to continue to move money to mutual funds or money market accounts or buy them 1 month. And I know Fed funds is still off. I'm not going to get into that today. But what I'm going to do is just talk about facts. Here's the doji on the break. That was the doji of the break when all heck broke loose, okay? And we are still holding that level. I'm not suggesting that you're going to rally right away, but you're going to have winners, and I'm going to walk you through some winners. And I'm going to walk you through who I think the next couple winners are. And then we're going to talk about some other things here that are going on macroly. But I think that this is very important for people to get this concept. So here we are, and we know that we've broken down, right? And we know that we've lost banks. We know we lost SIVB, right? We all know this. One day it was at 100. The next day it's at 2, right? We all know we lost SBNY, okay? We're all aware that we lost these banks, okay? We're all fully aware that they've completely imploded. And now they just have these weird charts, right? So who's next? FRC. Why shouldn't this be a shock to people that have been watching these videos? Okay, so this is a chart that I did not put together. Let me just click this off up here. Gotta be a way to not make that as ugly as it is right here. And comment if you care that these videos are a little rawer and not as edited. Quite frankly, it just means that I can get more data to you, more information to you, which is what I'm starting to realize how I want to go. But I'm interested in your opinion on that. SIVB, SBNY, FRC. I'm shocked. It's shocking. Okay, you're at the high end of tier 1 capital unrealized losses in the top right quadrant, and you have the most deposits higher than 250,000. Did you think people were going to leave, or did you want to see if they thought the Fed was going to do their job or not? I know where I would be if I had an account at First Republic, especially after that conference call this week. So we're seeing this. Now, we're going to have to get into PACW here in a moment, but I want to point you to this section, okay, where you're seeing JP Morgan, NYCB, PNC, MTB. Well, FRC is going in receivership this weekend with all accountability. The most likely they are, which means their assets are now backed by the government. And guess who likes to buy assets when they are backed by the government? Other banks. Okay, and we're going to walk through two that did an exceptional job of this. And we're going to walk through two banks that possibly are going to be in the same base with FRC. Okay, right now it is rumored that JP Morgan and PNC are bidding on FRC assets. JP Morgan and PNC are the next two names that could move dramatically higher because they're going to have a backstop from the government through receivership. Okay, it's just a matter of time. The question is, at what equity price does FRC go out, or is there any equity left at all? Right? That's really becoming the question. We've been talking about this forever and how ridiculous this is. Nobody wants to partner with them. And why would you want to partner with them when you can have a guarantee, right? It's just the way that it is. Why would you partner with them? Just wait for them to go to zero and then go buy the assets from the Fed and get a backstop. It just makes sense, right? Now, the Fed's going to cut a deal. Why? Because they don't want to mark these assets. Because if you mark to market the assets of FRC and FRC had to sell all their assets on the market, every other regional bank is going to have to market the same. That's not going to go very well. It's going to be a real problem. FDIC knows this. They're going to cut a deal. Okay. Now, FCNCA, they bought assets. When they bought assets from the failed bank of SIVB, or whether they buy assets from SBNY, it doesn't matter. Okay. They bought assets from a failed bank. Look what happened to the stock the day that they bought the assets. There are two things that you need to be aware of. Okay. Number one, you do not have the resources of the FDIC. Neither do I. So in other words, we can't go through FCNCA Bank and do a full audit, but the FDIC can. So if they did a full audit on this bank and they came out and said, we like how strong you are, you're allowed to buy assets. Okay. They're the banks you want to buy. Okay, so FCNCA is one of the banks that if you're looking long-term, you want to buy. I did not understand the terms of this agreement, so this is not the one I bought. I'll show you the one that I bought. So when they go out there and they bought assets, from, I believe it was SBNY. Okay, so the FDIC goes to them and says, here, so the FDIC goes to them. This is from the newsletter. If you don't get the newsletter, please subscribe to it. It's free, link in description. It's definitely worth getting. I've been a little behind in putting it out lately, quite frankly, just because I was battling COVID, just to not get too personal, but at least it's behind me. I'm on the tail end of it. So you'll start seeing the newsletters again, and we'll go from there. But it's free, and I would strongly suggest that you get it. So NYCB, okay, the date that this moved, they were allowed to buy assets. Well, how did those assets perform? Okay, I don't know. We only surprised to the upside by 1,500%. I mean, how well can your assets do if they're guaranteed by the government and you're getting them at a discount and you're protected? And oh, by the way, it's treasuries. Okay, it's a slam dunk. Your revenue are up 333%. It never made any sense to me that this was all it did, right? So this is something that we actually own in the Alpha Chasers community, and we've owned for weeks, just sitting here owning a very boring company, waiting for the rest of the world to figure out what the heck's going on. So if I'm showing you this and you see NYCB and you see FCNA, well, who's next? Well, PNC is bidding for assets. Okay, PNC is bidding for assets right now with JP Morgan. I guarantee you that PNC gets a piece of that. There's no way that they're going to give all the assets of FRC, which is huge, to JP Morgan. They're going to give some to PNC. PNC fits perfectly into that category that we were just talking about, right? So if we think that way, and we know what the next bank is that may get assets, and because now it's out that they're bidding on it. It was not out before that they're bidding, right? We knew JP Morgan because they're the 800-pound gorilla. They buy everything, right? He's a beast. But if you think about PNC and you realize that PNC could be setting up to have a reaction like this, it might behoove you to pay attention to PNC next week if the news doesn't hit by Monday morning. Okay, if it doesn't hit by Monday morning, I would be looking at PNC. Okay, Long way to get there, but now you understand why. Okay, so let's say that this is over, and it appears that it's over, right? Here's the financial sector. 33 is the issue. I'm going to clean all this off. And let's drill into this on a month and look at what's going on. There's your monthly chart. Never took out a low on FCX. I'm sorry, on, I've got copper on the brain, so I'm going to do that next. We never took out a low on XLF, okay? We never did. If we look at this and we go, well, what are we doing? I mean, there's very little for me to say here. What are we doing? Oh, well, financials are going to break. Are they? Are they going to break down? Or do I have a failed H and I'm setting up the mother of all flags? Because it sure looks to me that if I clone this and I just take a second and just see if this fits anywhere, looks to me like I'm setting up maybe the mother of all pendants, right? You can see it back here from September all the way down. And maybe that's what's going to happen. Maybe not. You're wedged in here. And this certainly, if you're not taking out the October low and you're losing banks, you're not taking out the October low. So how can the market go higher? Well, maybe it's going to be a broad-based buying with no leadership. I don't know that that's sustainable. And that's my concern with the market. And this is where I'm going with this. S&P has not gone up consistently unless XLF goes up, okay? So now you understand where my head is with the financials. I think you could do the same exact thing with JP Morgan. I'm suggesting with PNC. I think it's a little different. I would suggest that if you are interested and you are a long-term investor, and I manage different portfolios, in the way that I manage between day trading and then long-term position trading and swing trading, I would strongly suggest you look at some of these banks like MTB that are in the bottom left of that corner. These to me are going to be names that people are going to look back in 6 to 12 months and say, I can't believe I could have bought that. I'm not going to equate it to like Amazon when it was down during the tech bust, because it's never going to have that kind of momentum. But you're getting companies at discounts that you were not able to get at discounts before, okay? This is MTB is one that I always point out. And I always say when FRC blows up, I'm just going to add to it. I have a position here. I have leaps in it. And I just want to walk you through something here. So if you look at this quarter and you have April 27th, and you can see that you're making 7 cents and you did 2.4 billion, right? And then you come back and you look here and you look at the same quarter and you were doing 1.4 billion, okay? And I know times have changed and now we have a discounting mechanism to these levels. I get it. I understand that. But do you have that kind of discounting mechanism that's assigned to them? In other words, our revenues are up about 30% year over year, and the stock's down 40% or 30%. Seems like a huge discount to something like that, doesn't it? And this video is pretty long. I'm aware of it, and it's just just the way that it's going to be. So here's FCX. What did he come out and say? What did the CEO come out and say? We have so much demand for copper that we're going to have to figure out how we're going to increase production. Okay, I'm not so interested in what the stock did, but let's talk about that. Okay, revenues are up 3.5%. They beat by 15%. We always hear people talking about copper futures. Copper futures are not breaking down. We keep hearing that copper futures are what we have to watch because they determine whether or not we're going to have a recession. Now, someone's going to tell me, oh, they're going to break down in 2 months. Okay, well, I don't know what's going to happen Tuesday, let alone in 2 months. All I have is this, and this is what I have to go on. And then as I get more data, I'll make more decisions. Does that look like something that's going to break down? Okay, the answer to me, no. It looks to me like something that's kind of wedged in here, trying to figure out what it wants to be when it grows. So I would continue to monitor copper. Semiconductors and what's going on with semiconductors is something that we really need to talk about here. So here we are with the SOXX, and here's what's going on. MACD setting up a bearish cross. We're going to get to that on the daily. Here's your monthly MACD. Here's your support level. I've got a tweezer bottom is what this is called. Now, this is not the position I want to be in, where I've got 3 dojis down here and I'm hoping. Hope is not a strategy that I employ. So I am watching this extremely closely, and I'm watching this 395.33. One of the things you might want to remember from this video, 395.33. You want to watch that level. But what are we saying? Well, let's take a look and flip to the weekly, and then we'll get to my notes there. Well, that doesn't make me feel warm and fuzzy, right? I've got a cross here. So if I like MACD on the weekly basis and I'm looking at trading, well, it's very difficult to feel warm and fuzzy about that. Well, how many times have we crossed here and then just reversed? Well, it's happened a couple times, so maybe it's going to happen. But, I can only trade what's in front of me. Let's go take a look at the daily. Well, we broke the 0 line on the daily, and what's happened? The histogram's starting to try to change colors again. The signal line is still pointing down. The MACD line is starting to try to curl up. Well, that's interesting. Am I setting this up? right? Am I setting something like this up? And the answer is we don't know yet. But there are some signs here of some things that we should talk about. So we're just going to lift this up here for a moment. And I'm just going to draw this line so that you can see it. Note how the histogram is getting smaller and smaller, right? So that seems interesting. Well, why is that happening? Let's clean up this all off and let's talk about that. So we're seeing the histogram go up, and at the same time, what's happening? Well, at the same time, the market's going higher, meaning the sector market of the SOXX. So if we look at this and we go, okay, well, this is going higher. At the same time, we're pulling back less and less. But what else is happening here? Well, this is happening too, right? Say it. We're still dropping, right? The histogram's dropping. So what's happening in here is that semis are getting tighter and tighter. You can even see it with the MACD down here, right? So what does that mean? Well, that's a good question. Does that mean we're going to consolidate more? I don't think that's what it means. I think we're coiling, but we have to take a look at these three names because this is really important. ASML, great earnings, rallied up, broke down, trying to reclaim it, not able to do that. TSM, great earnings, tried to rally up, held here on the 200, but we're down $10 from earnings on a decent report. Lam Research, look at the reversal. We broke over it, came all the way back, dropped $30, now we're rallying. Okay, so we have that, and we're looking at that, and they're starting to get better, right? They're not getting worse. All right, well, let's take a look at this. Well, Intel beat. Okay, so we're starting to see the legacies beat. All right, so Intel beat, Texas. Texas fell apart on earnings, right? And now below the 200-day moving average. We have mixed data. We start going through it and go, well, what's going to be the leader? Is it going to be IGV? Okay, well, maybe it is going to be expanded tech and software that's going to be the leader. Maybe that is going to be the new leader for a little bit of time, right? So you may want to go through the IGV names. I'm giving a lot of information today, guys, so you're going to want to watch this over and over. Okay, all right, so we look at cloud. Maybe it's cloud. Well, it's certainly not cloud. Okay, so it's not cloud, right? Because we're below the 200-day moving average. And with what Amazon came out and said, they're not adding all those accoutrements to it. And nobody's going to be looking at that and going, you know what I need to do? I need to buy Amazon and get involved in AWS as it can't break the 200-day moving average, right? Very different story than Microsoft. And I would just recommend that any company say AI at least 40 or 50 times on a conference call because that seems to be the driver these days. So we understand that there's nuance. So we start going, okay, well, where are we with the communication? Because I was throwing in the towel in the communication sector. And then we're flipping. Now guess what we're doing? We're setting up to break out on the communication sector. We rejected 5960. These are old notes, and we're setting up to break out. But let's drill into this for a minute and really talk. So there we are on the weekly, and there's your 200-week moving average. Let's shrink this down so that you can see it. Okay, so we're flipping here on the weekly, and we're above. And this close is the highest weekly close that we have had, okay, since back here, right? Since over a year, you have a 12-month weekly highest close. Let's go out and take a look at this on the monthly and drop this over here and see what's going on a monthly chart. Okay, does this look like something that could be the leader? It sure looks a lot different now than it did 2 days ago. Okay? And that's because of the GDP and the PCE and the expectations for what the Fed's going to do. When I started this whole thing, that's why I said, I think I'm discounting that, and that's why I think there might be actual upside risk for people in the market. Well, how is that going to play out? We can all see this MACD cross. Let me explain how that's going to play out if there is upside risk. So this is one of the research papers that I read, and I'm just going to show it to you through Dropbox to save some time. The upside panic in a pick with implied vols at rather low levels. Just use those options to play direction and or get some long gamma on board and hedge the deltas. These moves are huge and gamma is cheap. Long gamma is always a good way to regain confidence and trade the market from the right side. Look at the panic call buying that's going on here in the market. Look at the time that this happened, which was the end of the day. Who buys between 2:30 and 3 o'clock? Institution. Look at the amount of panic that kicked into this market. Now, before we get into another part of this that I think is very important, I just want to show you what's going on. So I'm saying that we're bottoming and we're tightening and we're tightening. This asset research firm, and this is from Bloomberg, semi should have plenty of upside if this is a new cycle. So what it does is this shows the performance from trough to peak. This shows the cycle from trough to peak. And if you take a look at the cycles on where you're at and the runs that those cycles have had, versus where you are now and number of months from trough to peak, and it shows you where you're at, you're nowhere near on a peak cycle. You're not even remotely close to it, right? So keep this in mind as we talk about semiconductors and whether or not semiconductors are going to participate. Now, one of the charts we always talk about is smart money, dumb money. And we don't refer to it as that because we've seen retail outperform. So we call it institutions and retail. So now if we take a look at this and we drill into the yearly and just look at it, are institutions underweighted or overweighted? Right now, they're underweighted, and retail is not really overweighted. We're not over an extreme level, right, as we are back here. But usually, this marks a top, okay? And that's something that we have to be aware of. But what if it doesn't mark a top, right? So we always have to think that not only do we have to look at what's going on, but we also have to look at what it represents. What it represents right now is that you're going into a Fed meeting. You have a solution to the banking crisis. As far as we know, there's nothing else out there, right? We can only trade what's in front of us. And institutions have the lowest position that they've had in the past 12 months. We literally have to go back to pandemic levels. Let's clean all this. We have to go back all the way to pandemic. We have to go all the way back to when we had a pandemic to find anything like this and where we're at right now. So I think that's a really important distinction. And I think if we take a look at it from that perspective and realize institutions are so out of position right now that it's scary. So that's it. This was a little longer, but what I'm trying to hammer home is the fact that we're in a position here where we are grossly underestimating what could happen. That's my sense of it. And I think one of the things that I did a poor job of was not understanding that people were still thinking that we were going to see more and more rate hikes. So as always, please comment below. This was a long one. I'd watch it a couple times. Have a great weekend, everybody. Trade to win.